I'm as interested in your year-end call as I am in what you see happening in 2016. What do you see happening next year?
Well, I would anticipate that this year has been so it's been lousy, really, when you consider the performance of the market. It's been hit with just about everything but the kitchen sink, and yet has been remarkably resilient if you look at the averages. It's not anything significantly down in terms of the major averages. But we'd have to think that 2016 will likely be, especially as we view it here towards the end of the year, as people will expect that it'll be a better year than this year.
The trends aren't favorable, though. I'm looking at third quarter earnings. We've got all but 8 companies in the S&P 500 reporting. Revenue growth, -4%. Earnings growth, -5%. Of course, a lot of that has to do with the collapse of energy, but nevertheless, there are a number of other sectors still showing weakness. Materials, industrials, for example, healthcare, utilities.
Well, it related to materials and industrials. They naturally got dinged by what was going on in the oil patch. But we would expect that as global growth comes back, those sectors will do a lot better. And in fact, if you go back to the rally that occurred since September 28th of this year, among the best performing sectors, you'll find materials and industrials. You'll even find energy. I'm underweight energy on a fundamental basis. But industrials and materials, my recollection is they were in the top 3.
But the issue is that we're having slowing demand in China, which has been well telegraphed. But we heard today that corporate profits are also down as well. Also, it seems like the lower for longer oil story is really here to stay. So without higher oil, without a substantial China industrial growth, how does the market move to 2311?
Well, I would have to say that the 2311 it will likely be would have to be based on a bit of a Santa Claus rally. It would have to be an anticipation of a better year next year, and then it would also fall in line with fourth quarter rallies that can be remarkably powerful. A combination of window dressing, but managers anticipating what's going to happen next year, and we can't help but think. Well, you talk about a bifurcation, a place of bifurcation within the markets. There are those who are bullish and those who are bearish. It's pretty well down the middle right now. But we would have to think that looking at next year, all that QE in Europe, QE in Japan, China utilizing stimulus, they have responded to their problems better than anybody would have anticipated. We'll have a better year, and the market tends to feel that.
You mentioned moments ago one of the key challenges for anybody in your position. Any strategist at the same time has to be something of a macroeconomist, doesn't he? Because you are counting on QE in Europe to drive growth. You are counting on QE in Japan to finally gain traction. What if they don't?
Well, I think what if they don't? Well, we're going to see underperformance, but I'd have to think that...
And we're going to have more problems than that.
But just what we saw... But just what we saw today, that the news out of Europe was better. We've gotten data points coming out of Europe that would indicate better than green shoots in terms of economic growth, whether it's Spain in third quarter, whether it's Germany, low unemployment rate. And this is within a challenging situation, and we can only think of our own challenging situation and how well we've done that we are now beyond recovery and in an economic expansion that appears sustainable enough to withstand the beginning of normalization of interest rates authored by the Fed, probably in December. I hope it's in December. I hope we don't have to wait till the first quarter.